it's Natasha from eXp Realty here in Barrie, Ontario. Welcome back to my channel where we dive into all things real estate from buying and selling to investing in market trends. Today we have an important topic to discuss, the recent changes to the capital gains tax in Ontario and how it will affect homeowners and investors. So let's get into it. Introduction to capital gains tax. First, let's quickly cover what capital gains tax is. In simple terms, it's a tax on the profit you make from selling an asset, such as real estate. This tax is calculated based on the difference between the selling price and the purchase price of the property. For example, if you bought a property for $300,000 and sold it for $500,000, the profit or capital gains is $200,000. The recent changes in the capital gains tax have sparked a lot of discussions, and today we'll break down these changes and their implications. Overview of the new changes. So what's changed? The federal government has increased the inclusion rate for capital gains tax from 50% to 66.67%. This means that now 2/3 of the profit you make from selling a property will be considered taxable income compared to the previous 50%. For example, if you have a capital gain of $200,000, under the new rules, $133,340 will be taxable instead of the $100,000. This change is aimed at increasing government revenue, but has significant implications for real estate investors and homeowners alike. The new rules will apply to capital gains realized on or after June 25th, 2024. This means that any profits made from the sales of assets, such as real estate or investments, after this date will be subject to the new tax regulations. Impact on homeowners. For homeowners, especially those considering selling their primary residence, these changes might seem alarming. However, it's important to note that the principal residence exemption still applies. This means that if you're selling your primary residence, you won't have to pay capital gains tax on the profit. But if you own additional properties such as cottages or rental properties, you'll be affected by the increased tax rate. For individuals, the first $250,000 of capital gains each year will still be taxed by the 50% inclusion rate. Any gains above this amount will be taxed at the new 66.67% rate. For example, a high-income individual in Ontario with a $300,000 gain from the sale of a second property will see an increase in taxable income from $150,000 to $158,333 under the new rules. The first $250,000 will be taxed under the old rate, and the remaining $50,000 will be taxed under the new rate. Impact on investors. Now let's talk about real estate investors. This group will feel the impact of the new capital gains tax the most. Higher taxes on profits can reduce overall returns on investment. For example, if you sell a rental property for a significant profit, you'll now pay more in taxes, which could affect your investment strategy and future purchasing decisions. It's essential to reassess your investment portfolio and consider strategies to mitigate these tax implications. Additionally, corporations holding passive investments will see the inclusion rate increase to 66.67%, impacting every single dollar of capital gains. Strategies to mitigate the impact. So what can you do to ease the impact of these changes? Here are a few strategies. Holding period. Consider holding on to the property longer to maximize appreciation. For example, if you bought a rental property for $300,000 and its value increases to $500,000 over 10 years instead of 5, you could benefit from additional appreciation and rental income. Sell before June 25th, 2024. For individuals and businesses, it's crucial to consider the timing of asset sales. If you plan to sell an asset and realize a significant capital gain, doing so before June 25th, 2024 will result in a lower tax liability under the current 50% inclusion rate. Incorporation. For those with multiple properties, incorporating your real estate investments can offer tax advantages and protect personal assets. By holding properties in a corporation, the increased inclusion rate can be managed more efficiently. Consult with a tax advisor to see if this strategy is beneficial for you. Lifetime capital gains exemption. Utilize the increased lifetime capital gains exemption for small businesses and certain properties, which will increase to $1.25 million. This exemption can significantly reduce the taxable amount when selling qualifying properties like small businesses, farms, or fishing properties. And another possible strategy to help ease the impact of these changes is charitable donation. Donating appreciated assets to charities can also reduce your tax burden. You can donate securities and avoid payment capital gains tax on the appreciation, receiving a charitable deduction instead. In conclusion, while the increase in capital gains tax will undoubtedly affect homeowners and investors, understanding the specifics and planning accordingly can help mitigate the impact. Stay informed and consult with a tax professional to explore the best strategies for your situation. If you have any questions, feel like you need to sell your home before June 25th, 2024 to avoid these new costs, or need personal advice, feel free to reach out to me. I'm here to help you navigate these changes and make the most of your real estate investments. Thank you for watching. If you found this video helpful, please give it a thumbs up and subscribe to my channel for more real estate tips and updates, and hit that notification bell so you never miss a video. If you have any questions or topics you'd like me to cover, leave a comment in the comment section below. Until next time, happy house hunting and investing.